Real yield farming explained, the smart way to earn in DeFi. In the early days of DeFi, yield farming was all the rage. Projects offered triple-digit APYs just for locking up your crypto. It looked like easy money, until the rewards dried up and token prices collapsed. But in 2025, a smarter and more sustainable model is taking its place. It's called real yield farming. In this video, we'll break down what real yield farming is, how it works, what platforms offer it, and how it compares to traditional DeFi farming. If you're looking for a reliable way to earn crypto income, one that's not based on hype or inflation, this is the strategy to understand. But first, a quick disclaimer. Crypto assets are high risk and not regulated in the UK. You could lose all the money you invest. There is no consumer protection. This content is not financial advice. Always do your own research. Let's start with the basics. In traditional DeFi yield farming, users earn rewards by providing liquidity or staking tokens. These rewards are typically paid in the protocol's native token, which the platform mints and distributes freely. The problem: this often creates inflation, driving down the token's value over time. Real yield farming, on the other hand, is based on actual revenue. You earn rewards not from newly printed tokens, but from platform fees, trading volume, or real-world income. The rewards are often paid in stable coins, ETH, or BTC, making them more sustainable and valuable. In other words, real yield is income generated by actual economic activity, not artificial emissions. It's closer to earning dividends or profit share than riding a hype train. Let's take a real-world example. GMX is one of the most well-known real yield platforms. It's a decentralized perpetual exchange where users trade crypto with leverage. The platform charges trading fees and distributes a portion of that revenue to GMX stakers. If you stake GMX, you receive rewards in ETH, on Arbitrum, or AVAX, on Avalanche, depending on where you stake. The more people trade, the more fees are generated, and the more you earn. It's simple, transparent, and based on real usage. Then there's Pendle, a yield management protocol that tokenizes future yield. It allows users to buy and sell yield streams, essentially turning passive income into a tradable asset. Pendle collects fees from these trades and distributes them back to YT and LP holders in the form of ETH. Curve is another popular DeFi platform evolving toward real yield. Known for its stable coin swaps, Curve has shifted from hyperinflationary CRV emissions to models that prioritize protocol revenue and VEC-RV voting. Users who lock tokens get a portion of the trading fees, again, driven by actual volume. Ethina is a newer project making waves in 2025. It offers yield through delta-neutral positions and hedging strategies. Instead of relying on token emissions, Ethina distributes income generated from funding rate arbitrage, making the USDE stablecoin one of the first to offer real yield on a dollar-pegged asset. The benefit of real yield is that it's more predictable and sustainable. You're not relying on token inflation or market speculation. Instead, you earn a share of what the platform actually makes, often in assets that retain their value. So why is real yield gaining traction? First, it solves the core issue of unsustainable farming. In the past, projects would offer 1000% AP to attract users, then collapse when the rewards ran out. Real yield flips that model, rewarding long-term holders and users based on the platform's actual success. Second, it creates better alignment between users and protocols. If the platform grows and generates more fees, you benefit directly. This encourages users to support healthy, active ecosystems instead of chasing quick exits. Third, it attracts serious investors. Institutional DeFi participants, long-term builders, and professional traders prefer stable, revenue-based income over speculative farming. Real yield offers that reliability. But it's not without risks. Real yield depends on platform usage. If trading volume drops, fee revenue drops too. Your rewards are directly tied to how active the protocol remains. If users leave or liquidity dries up, your income shrinks. There's also platform risk. Even though the yield is real, the protocol itself could face security vulnerabilities, governance failures, or economic shocks. Always research the platform's audits, team, community, and tokenomics before participating. Another consideration is volatility. While many real yield rewards are paid in ETH, AVAX, or stablecoins, some still require you to stake volatile tokens like GMX or Pendle. If the token's value falls, your capital could still take a hit, even if rewards are solid. So how do you get started with real yield farming? Step 1. Choose a platform. GMX, Pendle, Curve, and Ethina are leading examples. Each has different mechanisms, supported chains, and payout structures, so take time to understand what suits your goals. Step 2. Connect your wallet. Use MetaMask or another Web3 wallet, and ensure you're connected to the right network, like Arbitrum for GMX or Ethereum mainnet for Pendle. Step 3. Stake or provide liquidity. This may involve buying the native token, locking it for a set period, or depositing LP tokens into a pool. Always check the APR, lockup terms, and risk disclosures. Step 4. Track your rewards. Most platforms have dashboards that show daily or real-time earnings. You'll often be able to claim ETH, USDC, or platform-specific tokens, depending on how the revenue is distributed. Step 5. Diversify. Don't go all in on a single platform. Even real yield has risk. Spread your positions across a few projects to balance exposure and optimize returns. If you're looking for lower risk exposure, consider staking only the minimum required amount or using liquid staking versions, like GLP for GMX. You'll still earn yield while maintaining flexibility. Some protocols also let you auto-compound your rewards, meaning your earnings are automatically reinvested. This can increase your returns over time, but it's important to monitor fees and price impact. For those who want to participate passively, certain DeFi asset managers and vaults now offer aggregated real yield products, where you deposit stable coins and let a protocol handle the rest. These are great for beginners, but make sure you trust the vault provider. Real yield is not just a trend, it's a sign of crypto maturing. As more platforms shift from speculative incentives to revenue-based rewards, the ecosystem becomes stronger, safer, and more sustainable. You're no longer earning based on hype or inflation, but on real economic activity. And that's a powerful step forward for DeFi. So, is real yield farming right for you? If you're tired of chasing unsustainable APRs, if you want to earn in ETH or stable coins, and if you believe in protocols with actual usage, then yes, it might be exactly what you're looking for. Just make sure to do your research, understand how rewards are generated, and only commit what you can afford to risk. Crypto is evolving, and real yield is a big part of its future. If you found this helpful, check out our other videos in the income series, from staking and airdrops to savings and revenue sharing tokens. And don't forget to like, subscribe, and comment with your questions. This is Crypto Pulse, where deep dives meet real insights.